Welcome to episode 5 of Level Up. And today we're going to be talking about the different types of companies. And if you're following along, feel free to grab a copy of this book. It's Peter Lynch's One Up on Wall Street. And we're going to be focusing on his writings in chapter 7 of this great book. So one of the things that Peter Lynch says in his book is that when you find a great idea using your consumer's edge or your professional's edge, you should basically treat it like it's a mysterious stock tip. Amar, what do you think he means by that?
I think he wants us to keep an open mind, assume that you don't know anything, and then think of it as a puzzle that you have to solve without much, just go in with an open mind and figure out what it is.
I would say he's asking us to be skeptical, try to poke holes in this idea as much as possible to see what could be the downfall of this company, right? Not get married to an idea just because you've come up with it.
Right. I think he's also reinforcing this idea that idea generation is merely the start of the investment process. That in the past, I think we've all known people who have just taken an idea and just gone ahead and bought the stock. And that's really kind of a rookie mistake that is really just the beginning, and you need to look into this in more detail.
Yeah, absolutely. Develop a process around it. I'm sure Peter Lynch has his own process and both of you have your own process, but one way to go from idea to investment is to have this process. So for me, for example, I take an idea, I start researching it online, look at messaging boards, look at review sites, look at their website, right? Amazon.com if it's a product. And then you do an even more deep dive, right? Financial analysis, read the 10K, read the last quarterly statements, listen to the earnings calls and do more due diligence. And then lastly, do channel checking, right? So call up their suppliers and their customers, people who aren't their customers, and ask them why. All this deep dive due diligence that is required into making an investment thesis, right? So that's a big thing, making an investment thesis. Throughout the time that you're researching this company, doing analysis on this company, develop why you think you should invest in it. And most importantly, develop why you think you shouldn't be investing in it, right? So I think those are the key points that need to happen after an idea generation to get conviction to buy the company.
Another point that Peter Lynch makes in this chapter is that if you're going to buy a company based on a product, that it's really important that you figure out how much that product will contribute to a company's bottom line. Can you elaborate, Amar, on what he means by that?
Yeah, let us take some of the big companies that we know in life, right? Like Chipotle. Their main product is they sell burritos in a store, right? That is vast majority of their revenue. They also are trying new concepts like Asian food or pizza. Like the contributions of these other stores are essentially zero to the bottom line. So just because you fell in love with their pizza chain, you are not gonna go buy Chipotle. You have to figure out what is the percentage of this particular product's contribution to the company's revenue as well as the company's earnings, and then go from there.
Another point that Peter Lynch makes in One Up on Wall Street is that big companies usually make small moves. Now, what do you make of that statement, and do you agree with it?
It is a very good statement, and that is the consensus. For the most part, big companies don't make big moves. But I don't think that is always true, right? For example, I'll give an example of Google today. They are a big company, but they have a huge self-driving arm, which everybody thinks is gonna be a whole new industry. So it is always good to be aware of the differences when a difference exists, where a big company which already has huge potential in their current business, like for example, Apple with iPods, could actually be building an even bigger business that was the iPhone.
Okay, let's now talk about the 6 categories of companies. And specifically, Peter Lynch has laid these out as fast growers, slow growers, stalwarts, cyclicals, turnarounds, and asset plays. And for each of these, let's have kind of a lively round-robin discussion about each of these types. And specifically, let's talk about whether you personally invest in these companies and if you have any advice on these companies or these types of companies. Let's start, Brenda, first with fast growers.
Yeah, this is my favorite category of company. I try to target this category of investment because to me it seems with my limited access to information and very long-term time horizon in investing, this is the quote-unquote easiest category for me to invest in, although maybe other people will disagree. So I definitely try to target the fast growers.
Yeah, me too. I love fast growers. What advice do you have for our viewers on investing in fast growers?
I would say when you invest in fast growers, be cognizant of the top and the bottom line growing at the same time, right? Because if a company is growing revenues very fast and that's not translating into earnings, then that might be something you need to look into and into why that's happening. Maybe the company's reinvesting that money to keep growing, which is fine. Another thing is going back to this idea of investing in companies that have a lot of room to expand, right? If they have a lot of room to expand, then they can grow into the exponential growth that you're seeing. Otherwise, they could be heading down a wrong path.
Amr, do you have any thoughts on fast growers?
Yeah, fast growers are always good if you can find them at a reasonable price. The problem with fast growers is as soon as it is known that these are fast growers, the price goes up and then your price versus value becomes really hard to balance out and decide if it is a good buy.
Great thoughts. I think it would also be helpful if we gave some examples of fast growers, and at least at the time of this viewing in 2019. So on my list, I think some popular fast growers right now include companies we've talked about, such as Amazon. Another fast grower is Ubiquity. And one that's probably more down to earth is Texas Roadhouse. That's like a brick and mortar restaurant. It's probably not growing at 30+%, but it's growing at a steady clip. Okay, next let's talk about slow growers. And Peter Lynch is pretty clear that he dislikes investing in these companies. Amr, do you ever invest in slow growers or no growers?
Rarely. Sometimes the slow growers prices, especially in a bull market, sometimes the slow growers prices are so low that you could still buy them and make 2x or 3x your investment. Then they actually become a good investment.
Yeah, I know a while back, didn't you invest in a coal company that was definitely a no grower?
I did. And it was at during 2016 where this company was paying about 35% in dividends, and it was very clear that they have enough contracts to pay this dividend for the next few years, 5, 6, and so we bought them at a really cheap price, around $5, and because it was really cheap, the price also went up to $15, but they still are paying that 30% dividend at the original price. Wow. So we have done really well in our club.
Nice.
That would be a big reason for someone to invest in a slow grower, right? Is
exactly.
Generally they're dividend paying stocks, and that's a more predictable income for investors.
Great points, guys. Just for the viewers, an example of a slow grower would be a company like Tempur-Pedic. All right, let's switch gears and let's talk about stalwarts. Amr, can you first tell our viewers what a stalwart is, whether you invest in them, and could you give folks advice on how to make money in stalwarts?
Sure. Stalwart, in Peter Lynch's definition, is a company with medium growth, but it is a very stable company that has a long track record and the company continues to keep earning that 10 to 12% growth irrespective of what the market conditions are. I mean, these do change, but one example could be a company like Apple, a company with a very strong brand that is still growing the revenue at 10 or 12% every year. They usually will do that irrespective of what the market conditions are based on how much presence they have in terms of the cell phone and the services that they sell on top.
I think another example of a stalwart would be a clothing company, a sports clothing company like Nike. Next, let's talk about cyclicals. Amr, what is a cyclical? Do you invest in them? And what advice do you have for folks on investing in cyclicals?
Cyclicals are companies whose fortunes change based on either the government policies or how the market is doing overall based on supply and demand. The classic examples are companies in, say, energy industry, right? Oil and coal, like they are or mining industries. These are commodity businesses where sometimes the demand far outstrips the supply and the company does really well in terms of growing earnings. And then since it is a commodity business, as soon as they start overproducing, the price falls a lot, and then the company is not making much money, and then they have to get through that portion. The thing to remember about cyclicals are, think of it as a tide. Everything kind of goes up and everything goes down. So when it is at the down phase, you will be able to find really good companies for a really cheap price. The important thing to keep in mind is to ensure that these companies can survive the downward phase, because lots of companies go down and never come up, and you don't want to be caught with one of them.
Yeah. I think there's some other pretty popular examples of cyclicals. So Peter Lynch talks about this. Car manufacturers are cyclicals because when the economy is weak, people are not generally going out and buying new cars. Other examples include Home Depot or Lowe's. During recessions, again, people are not probably spending hundreds of thousands of dollars fixing up their homes. Next up, let's talk about turnarounds. Brenda, what is a turnaround? Do you invest in them? And what advice do you have for people who are interested in these types of companies?
So turnarounds are companies that are generally, they're doing very well for a really long time. Then a big event happens and all of a sudden the company doesn't do well. I do try to invest in turnarounds because I think they're really good opportunities to get in at a very low price into a really good company if I think that the company will survive whatever event or that they're going through. One example of it, a big one that everyone might know is Volkswagen. Volkswagen had a huge scandal a few years back where they were cheating emissions testing in the US and in Europe with some of their, with millions actually of their cars. And so the company completely got hammered, and I took a look at it and I was like, Volkswagen is the biggest car manufacturer in the world. And do I think that they're gonna right this wrong and come out of it swinging? And the fact was that their balance sheet was very healthy, and I think a lot of people got punished for the wrong that they did to the environment and to people who were buying these cars, and I had very high hopes for it. So that was a turnaround example that I actually invested in.
Next, let's talk about asset plays. Amar, what's an asset play? And in the 21st century, is it still possible to make money in asset plays?
I think you can still make money in asset plays. At a high level, an asset play is you buy a company for less than the price of the asset that the company holds. Lots of times this happens because when, let us take a classic example, Berkshire Hathaway. Right? They have bought companies over the last 50 years, and some of those companies that they bought are still carried on the book value of what they paid like 50 years ago. But the companies have grown enormously larger and more profitable, like Geico. So you would rarely find companies, especially in real estate industry, where the company actually owns more land and assets than what it is selling for today. It is getting harder and harder, but you can rarely find one.
Yeah. I think another example, and again, this is admittedly very difficult, it's very technical, but there are a lot of tech companies these days that have patents to technologies. And so that type of intellectual property could be the modern day version of one of these asset plays. A company that comes to mind, a company that I'd completely written off as BlackBerry, but it turns out that even though their business failed, like the patents that they owned were actually quite valuable. So just one note is that we talked about 6 different companies, and it's important to note that any given company can be in multiple categories, or in their lifetime, they can go from one type to another type. So let's wrap this up. In conclusion, I think the key takeaways are that you should do your homework, and that for any given company, you should be getting into the habit of categorizing the company so that you know what to expect and how to analyze that company. Thanks very much for watching this episode of Level Up. If you enjoyed it, please subscribe and share it with a few friends. Thank you.